Full review of the ARKW ETF. That's what we're looking at today. My name's Jeff Beers. This is the 4D Finance channel. Let's dig right in. Okay, so the ARKW ETF is one that I own. It's one of the most expensive stocks that I own, given the management fee on this one. But it is actually, in my opinion, a good lesson on the difference between managed funds versus index funds and what kind of results you might see depending on what you choose. The ARKW is a fully managed fund. So it has analysts and a full team of people looking at stocks, making adjustments to the allocations, buying, selling, etc. So this particular fund is focused on and expected to benefit from the shifting base of technology infrastructure to the cloud. And it goes on, it actually has quite a few more lines there in the description, but you're looking at cloud computing, e-commerce, AI, mobile technology and Internet of Things, social platforms, blockchain, and peer-to-peer lending. So that is the general theme, and it's a broad theme. But I think what you'll see as we go through here, that some of these are the biggest emerging markets that there is across the world. The ARKW allows me to invest in companies I otherwise would ignore, either because A, I've never heard of them, B, I don't understand them, or C, they just don't fit the fundamentals of individual stock purchases I typically make, whether it's debt ratio, PE ratio, EPS, etc. So this allows me to have a piece of some of these stocks without going all the way in. Here are the top 10 holdings for the ARKW ETF. You have Tesla right now at 7%, Tencent at about 7%, Square, Nvidia, Twitter, Baidu, Netflix, Amazon, LendingTree, Spotify. So that's just the top 10, and none of those exceed a 10% weight on the ETF itself. So that gives you a little bit idea of what type of companies. They are all growth companies. All of these companies typically exceed a PE ratio that I would even entertain for myself. But the difference is with the ARKW fund, because it's managed, I technically have a team of people who are buying and selling these stocks to make compounding returns. Because a lot of these, if you were just going to hang on to them and wait for, like if this was your portfolio as a whole, you would definitely have some ebbs and flows, and you would be in what I would call a high-risk portfolio of individual stocks. So next we'll take a look at the performance of the ARKW Web ETF as opposed to some other big indexes. The blue line here is the ARKW, and this is since inception, which I believe is 2014 for ARKW. So you see the blue line. The red one is the S&P 500, and the yellow one is the NASDAQ 100. So absolutely amazing returns from this ARKW. Not a whole lot else to say. I mean, they blew away the competition. Obviously, past performance is never an indicator of future performance. However, in this case, even when we get into the fee involved with this particular ETF, it trumps any kind of performance barrier that you may have with the low-cost index fund. So they had a huge spike last year, really when things started to separate in 2017, where they got into a Bitcoin ETF, one that I actually own, it's where I found it, and Bitcoin obviously went up. The folks at ARK sold almost completely at the top, took profits, imported back into other stocks. So this wide separation is due to a singular event, or mostly due to a singular event. With Bitcoin, you also had Amazon, Tesla, some of these other companies, Nvidia, pretty much everyone on their top 10 list went up last year. So you see that spike, And that is to be noted, because if you didn't have that Bitcoin event, the results wouldn't have been as good. I still think they would have beat the NASDAQ 100 though, based on the other stocks in the portfolio. Okay, from a ratings and reviews section, this is a Lipper Leader scoreboard that is in my Ally Invest platform, so I decided just to share that here. You can see from a total return standing, the ARKW gets a 5 out of 5, consistent return 5 out of 5. Preservation, which means the preservation of capital, they are lower at 2. This is an interesting number, and you'll have to research it yourself, the preservation rating. ARKW is going to take a hit anyway, just because their inception date is 2014. So right off the bat, they're not going to be able to prove preservation of wealth. Some of that gets into the expense ratio, which we'll see in a little bit. On expense as a whole, they were 3 out of 3. Tax efficiency, 3 out of 3. Both total return, tax efficiency, and expense, they are in the top 150. And with the preservation rating at a 2, some of that's just due to the fact that the ARKW has only been around since about 2014. Now for the expense ratio, which is going to be the biggest ding in the ARKW proposal, so to speak, their management fee is 0.75%, okay? If you look at Vanguard type funds, regular index funds, you're in the neighborhood of 0.05, sometimes lower depending on what it is. However, keep in mind that an index fund is not a managed fund, okay? It simply takes who is in the index, and those are the only adjustments that are made. There's no opinions, there's no analysis. That's just what they do. So from a managed fund standpoint, the 0.75 expense is actually pretty cheap if you compare it to other managed funds. The problem is these days everyone takes ETF expense fees and they put them in a vacuum and they compare them against index fund fees. It's just not the same thing. And but you should know at 0.75 that that's a lot higher than you would get for a Vanguard. I know those are super popular on YouTube. They're certainly popular on the web, where people are taking back the power of expense fees, which is a great movement. In my case, I'm not really worried about it as long as I'm getting results, right? And so at the end here, and this is right from the ARKW prospectus, basically, if you took $10,000 in the ARKW fund and it grew 5% annual return, the fund's operating expenses remain the same, and you cashed out at the end of the 10-year stretch, you would pay $930. That price, $930 over 10 years, is obviously about $100 a year, and that's at a 5% return. ARKW is performing much better than a 5% return over the past, call it 2 years. So that fee would be higher, but you can understand that when you're getting higher performance, you don't necessarily care as much about the higher fee, right? So fees are relative to performance. If I paid somebody $1 and they lost me $500, I don't want to pay $1 for that, right? But I will pay someone $200 to make me $1,000. So that just kind of, fees are relative. And I think we spend a lot of time on the media community focused on fees and getting away from that. And in the case of ARKW, I just don't really think it's warranted, but everyone's entitled to their opinion. So that's a full look at the ARKW ETF. Hope you guys enjoyed it. This is one that I own approximately 50 shares of and might be looking into more for the future. Hope you enjoyed this video. My name's Jeff Beers. This is the 40 Finance channel. We'll see you on the next video.